Welcome to today's Corporate Venturing Insider Series. Today, I'm excited to introduce Nicole LeBlanc. For once, I can say with my French accent, she's partner at Woven Capital. Welcome, Nicole.
Thanks. Happy to be here.
So, Nicole, maybe you could start a little bit sharing about your background and how you got into corporate venturing.
Perfect. I did not take a linear path to get into venture capital. And because we have the time, I'll give you the long story.
Thank
Uh,
you.
I am from a very small town in Atlantic Canada of 1,000 people. And so growing up, this was not even a career I would have aspired to even understanding existed. And so it's really great to have ended up here and it's really exciting. When I started my career, I was an accountant. So I did really great in mathematics and these black and white courses and ended up going into accounting. And my first job was at a chocolate factory, which was wonderful. They actually would put all the extras by the photocopier. So the perks were definitely great in that industry. But it was really great getting that strong base of accounting and finance early in my career. And one of the things I used to do was these product costing. So I'd go down on the factory floor and ask about run rates of machines and talk to the people actually doing the work, which was really great. And I really didn't fully understand the whole process because it was early in my career. But now that I look back, it was great to really get that base. And for personal reasons, my husband and I moved physical locations. And so I had to get a new job. And so I was interviewing at different places and I accidentally fell into venture as a lot of people did at that point in time. So I've been in venture about 15 years, going through the interview process. And remember, this is really before you could Google stuff and get lots of really intelligent answers and things like that. And I remember saying, "Oh, you'll have a checklist and that will tell me if it's a good investment or not. So I'll know if we should be doing this." And like, yeah, something like that. And so then I ended up taking the job and it was really fun. And I would say in my venture career, I've had three chapters. And so there was that early venture activity where it was mainly in Canada, mainly at the seed stage, and it was meeting lots of companies and really getting under to understand the industry, pattern recognition, looking at different types of sectors, anything from direct to consumer jewelry to optical quantum computing. So it was a really fun chapter of my life, and it was mainly focused on early stage seed investing. And so the economics and the models kind of followed that path. And then I really ran into CVC after that. And so I led venture capital for the Sidewalk Labs project, which was an Alphabet and Google project in Toronto, really wanting to think about smart and sustainable cities. And so it was really great being able to just walk down the hall and talk to an expert in mass timber and buildings. And so I could really build a really interesting thesis around how to support prop tech and construction tech and like what the key levers were from a customer perspective. And so really enjoyed that part of my career and have continued on in my role here at Woven with a lot of the work that we're doing around kind of like mobility and cities and energy and how all of those things tie together. My career has kind of had those three chapters where it was the pure finance role, then the early seed kind of investment role, and now more of the proper CVC and really thinking about like how do you help a parent company think about innovation and new product development.
So, my next question was accounting. So, you have maybe some ideas or thoughts about the discipline that it brings, which you use today. What do you use today that relates to your background in accounting?
There's a couple of things. There's the very obvious things about understanding how finance works and understanding financial statements and being able to quickly review all of the financial statements. Couple of tips for people in the audience: always read the balance sheet and always read the notes. So if there's something uncertain or maybe unusual, those are always in the notes. So those are interesting to read. And always read the balance sheet. So don't take it for granted that other investors or other people have done the due diligence. A funny example is I was doing due diligence on a company in my past and I was reading the financial statements and they have first year and then previous year. And there was a line item called airplane. And I decided to ask the other investors who had already participated in the first close, what the background on that was, and they had failed to notice that there was a line item on the balance sheet for an early stage startup called Airplane, which is highly unusual. So I asked the CEO, very good explanation. They were located in an area that wasn't close to a major hub. They had an industrial product. They had to ship big pieces of equipment around. It was secondhand. It paid for itself in 6 months. So the explanation was fine.
Yeah.
Uh, but it's just unusual that nobody else, as part of the syndicate, had noticed the word airplane. It was very clear. And so I think some of those things is that I gravitate towards the financial elements. And so they're the first things that I look at. So it's very helpful when structuring and planning your due diligence process. The second element is because I was an accountant, it speaks to my structured personality. And so it really helps me with organization. I'm an inbox zero kind of person, and I have spreadsheets for everything. I have checklists for everything. And so it really helps as part of the due diligence process or a portfolio management process to be able to incorporate those things in my day to day routines.
So let's talk about checklists because then you moved into early stage investment,
Mhm.
which you could argue is not the same as late stage or even balance
Mhm.
sheet reading.
Mhm.
So how did you modify or adjust your checklist approach for early stage investments? And of course, what did you keep the same?
Uh, the fund that I was working at for most of my seed stage work, I was at a couple different funds, but one I had worked at, my team had deployed 187 investments across all sectors and all geographies in Canada. So we needed lots of checklists. At one point in time, we were deploying a company. We were capital closing an investment a week, plus including follow-ons and those types of things. And so there was also teams in various geographies. We weren't all in the same office. And this was 15 years ago. It's not like we could just jump on a Zoom call or things like that. So it was very important to kind of bring that level of organization. And for people in the CVC world that do early stage investing, like you'll know, it's very different than late stage investing, which what I do now. And it's really about a lot about challenging assumptions. And so the checklists were more about reviewing all the different assumptions as opposed to actually assessing historical activity because it really didn't exist. Or if it did, it wasn't very indicative of future success because it was lumpy or it was pilot revenue or things like that. So the checklist definitely became how can I, make sure that our whole team has visibility, that everybody knows their responsibilities, and that these discussions were actually much more about challenging assumptions and somewhat more philosophical how do you validate that somebody thinks they're gonna sell 100,000 units in the next 12 months? And so it became more future looking and getting kind of a little bit more of downside protection because our fund didn't have the ability to continue to follow on. And so you had to get the most bang for your buck in that first check. And so how do you do that? Because you knew you would get diluted over time. So thinking about not only how to assess a company, but also how to do the fund structure to kind of protect those economics.
You probably were the most structured early stage fund I know of. So I also want to ask about Canada. You come from Canada. How do you see the venture capital environment in Canada, maybe historically, but also recently?
So there's two key elements to what's going on in Canada that I think are actually indicative of some other jurisdictions. And now that I live in Japan, seeing the activity that's going on here, it's quite similar. So there's three key players in any sort of tech scene or tech startup scene. There's the private sector VC funds, there's the corporate VC funds, and there's the government. And so in Canada, and so you really need at least two of three really doubling down. And so in Canada, there wasn't actually a lot of activities from the corporates. If you look at the kind of the economy of Canada, it's a lot of commodity or like natural resources, old family run companies, things like that, that are quite conservative. And venture capital just wasn't an area that over the years they were very active in. So the other two players were government and the private sector. And the role that the government played was through a sovereign wealth fund for the most part, providing the ability to spur private sector investment to focus on how to get the tech sector more robust with a very aggressive kind of neighbor to the south that technically on average was about 10x any market size, and companies wanted to go to the US. How do you make sure that the Canadian ecosystem takes advantage of that proximity, but doesn't suffer a brain drain or having all the companies move? And so, how do you find ways to fund the companies at home to get where they need to? And I think that's actually also occurring in Japan, where there's actually a lot of activity from corporates, maybe less so from the private sector, and government's now starting to really double down in trying to find ways to spur the tech sector here. It's really interesting to see the dynamics in different countries between all three of those. And so in Canada, the government really plays a key role. And early in my career, it was more about just spurring any investment, so much more generalist. And now it's becoming much more focused. And at first, it was generalist funds, just trying to get out there. Now it's about having a strong fund of funds element, and also now getting into women-led funds, indigenous led funds, deep tech funds. So really trying to think about how do you spur in these really subsectors to de-risk the market, and then to get the private sector to come in and hopefully be able to run with it in the long term.
I like the way you're describing the latest trend is really about professionalization and much more granular.
Mhm.
Um, Maybe we can talk about fund of fund, and clearly this is something you've experienced, but why do you think it matters for Canada to have more of this fund of funds approach?
So this is something that at Woven we also think about is what is the value of fund of funds? And so fund of funds really help get sector and geographic coverage for a group like us. And in Canada, it's really about spurring private development. It's really interesting as a little bit of an adjacent item that if you grow up seeing entrepreneurs, you tend to want to be an entrepreneur yourself. And in economies where there's a lot of government jobs or big corporate jobs. So both of my parents worked for the government and a large private company. So I didn't grow up seeing examples of entrepreneurship in my own home. It was more something I saw on television. And so it's really important to think about how you spur that. And so it's the same with fund funds. If you don't grow up seeing tech as you kind of get into your career path, you don't think of venture capital as a career path for you. And so if the government can be very public about why they're creating these funds and or why they're supporting this, it then spurs people to think about creativity. And that's what you want. You want the private sector to lead with the government trying to amplify and risk some of that. And then over time, so right now, some of the government funds, some of the fund of funds have 50, 60, 80% government LPs. But then over time, by the time they get to fund three or four, that's significantly lower. And so it really can help spur that private sector element, which is what a lot of economies are looking for is how do you get the private sector dollars to flow?
And then now I want to lead on to Woven Capital because I was lucky enough that you shared with me one of your very thoughtful process about fund to fund. And you're probably one of the most advanced in terms of thinking about fund to fund strategically and tactically. Maybe can you share first at high level, why do you think a CVC will benefit? And of course, you touched about sector specific and so on, but the first thing that the board of directors will say is, why do you want to do fund to fund? So how would you answer that to a BOD?
It gives us sector and geographic coverage. Our team, most of us are based here in Tokyo. We do have some on the West Coast of the US. However, we can't cover everything. And as a global OEM, we need to know what's going on in global markets. And so I can go to the UK or I can go to Africa or I can go to New York, but I'm not embedded there and I don't really know the details of what's going on. I'm not embedded in the ecosystem. So by having a fund to fund strategy, it gives us deal flow and market insights that we would have to have a big team to do. And so it's just a more efficient way of us to get that insight. And then it's also not about just our one investment in that LP. It's about who are the other LPs. We're able to then network and make industry connections and share insights and learn from some of the other LPs when we go to some of these annual meetings or workshops that they have. And as an aside, I ended up at Woven because I actually jumped from
Yes.
one of our fund of fund investments. I That's how I ended up getting here. Is that instead of staying for fund two at my old fund, Woven convinced me to jump over here and then manage the relationship back to the LP investment.
So it's about access, including access of
Yes.
talent.
Yes, exactly.
Very nice. And well, but I think it's not just effective, it's also cost efficient. I mean, you could build a team in many geographies, but that would just be so expensive compared to very quickly get it. And you could argue, hopefully, if you choose well your fund, it doesn't cost you anything because it could actually return financial gain.
And some of the expertise and some of the fund of funds that we've invested in, we couldn't afford them, or they just wouldn't want to come work for us. That just we wouldn't be able to get the insights because of who they are and the networks and the role that they play. It's not like we could actually hire them even if we wanted to. The insights that we're getting are because of the fact that they are an independent fund, or they maybe are still tied to academia or some other very key industry.
Now, your fund is $800 million AUM.
Mhm.
You're probably extremely attractive when you knock the door on the fund. They reply and they want to treat you with a red carpet. How do you select the funds? Because even if it's geo-based, you still have so many choices. You need to be very thorough and pick which one will bring the best value. How do you go through the selection process?
So again, more checklists. And so what was important is we aligned it to our investment thesis. So just like you would build an investment thesis for your direct investments, we wanted to mirror that for our indirect investments in our fund to fund. And so where are the gaps? Where are the opportunities that we as a team can't cover or need access to? And so then we went hunting for funds that could do that. And I would say we were less concerned about maybe never some people don't wanna back a first fund. They don't wanna back an emerging manager. They only want tried and true and tested because they're entirely focused on financial returns. And financials are very important to us because if the company or the fund isn't going to be able to provide a financial return, like, they don't have longevity, which then can't give us the strategic returns. And so really looking for those experts that could really help us execute against our thesis. And so we ended up, deciding to allocate a specific percentage of our fund size to fund to fund, investing early in our fund cycle, in those funds. And obviously, mobility and the future of mobility was the key. But we also wanted to think about what is adjacent to our core thesis because we're not going to hire people to manage that internally because it's not core to our thesis. But it's still really important for us to understand trends in AI, trends in cybersecurity, trends in things like adjacent types of mobility to what Toyota looks at, vertical aerospace, robotics, those types of areas. And basically, that's what we've been able to build with our fund to fund portfolio.
Okay, so this is a golden nugget, which is using fund of fund not just for access to talent in different geographies and insights, but also where it would be very hard to justify recruiting for yourself.
Yes.
Like
Yes.
cybersecurity, very hard to justify recruiting when you work in mobility. But
Yes.
you need to know the impact of cybersecurity to Toyota.
And in industries like all of the OEMs, we're all transitioning from car companies to mobility companies. And technology just it is moving so fast now that although cybersecurity is a staple and everybody needs to have it, it's not necessarily a key investment theme for us, but because of a breakthrough like a ChatGPT, all of a sudden it could become a really important core element to our thesis. So we need to be able to monitor that over time because in 5 or 10 years, that might end up moving over and becoming core to us. We don't know. And so if we're not monitoring it, then we can't make those decisions.
Now, of course, when you mention monitoring, it means that you're not just investing, but you're engaged with them. You want to learn from them. How do you set up a good process to learn from the funds you invest? I feel like
So
there's a lot of best practices to learn.
yes, and we've done a few different things. It depends on the size of the fund, the size of their team, the alignment internally with our core thesis or adjacent, as I mentioned earlier. So typically, we set up a regular recurring meeting. And so the deal lead, whoever made that investment, they definitely attend. They let the rest of the investment team be optional depending on timing and what's going on. So some of those are monthly, some of those are quarterly. And then we have a set agenda with the fund for what we'll discuss. It's often market trends and deal flow is really the two things. Then we also want to engage the broader sort of corporate family. And we have a series of lunch and learns, and we pick a topic, and the some of the GPs would come and give a topic based on what they're seeing or some of their underlying portfolio companies, something that would be related to what we're working on. And so that way we're sharing not only the knowledge within the investments team, but also within the broader corporate around. Some engineers come because they want to do a deep dive in AI, as an example.
Very nice. So let's talk about the engagement with Toyota. First, from that lens, from all these different engagements you had between the funds you had selected, and of course, we'll talk to direct investment later, and Toyota, which one was the best engagement and why do you think that was?
I So we how we're structured, which is kind of just set background, is we have our investment team that does the typical investment activities. We source companies and then we make investments. We also have what we call a portfolio success team. And so what that team does is they really map out the problems that the business units are facing and help solve problems for them and then manage the portfolio afterwards. And as an example, we have an investment in a company called RideCell that does fleet management. And excuse me, I'm taking in the water. And RideCell is actually working with what's called Kinto, Kinto, which is a fleet that Toyota actually manages internally. And they were trying to build their own solution and weren't able to really get exactly what they needed. And it had to have differences for global deployments because we have cars in the US and we have cars in Europe and we have cars in New Zealand and Australia. And they were we were able to bring RideCell to the table to solve that problem. And so now they're deploying throughout the entire Kinto fleet.
Nice. And I like the terminology portfolio success.
Yes.
Tell me more about the team itself, the skills you have in that team, and how do you measure their own success?
We're just building out that team now. And so what they do is they're going to be co-located with the various business units that are a priority for us. And so if you think about us as an OEM, electrification, the things like new energy solutions, Toyota's big on hydrogen, thinking about the smart factory, connected cars, all of these different groups. And so we have people embedded with the US team, the European team, the Japanese team, really trying to be there in the day to day. So they can actually feel like they're part of, as an example, the electrification team in Europe. And they're doing meetings and workshops, and sometimes they're building their own solutions. Sometimes they're working with big companies, and sometimes they want to talk to startups. And so they're there every day knowing what's going on. And they can then bring the investment team in and say, okay, they are ready to work with a V2G company. Can you help them and do a sprint to focus on that? So that's one half of their job. And then the other half of their job is once we've made the investment, as a strategic CVC, what we have to do is also have an engagement with the portfolio company. So somebody is assigned to the example I used earlier with RideCell, and their job is to make sure that RideCell and Toyota continue the project that they've rolled out. And so we can hopefully keep it on time, make sure everybody has clear milestones and deliverable, make sure we're quantifying the value, and just making sure that the relationship continues on a path. And then an interesting thing that sometimes happens is the Toyota engineers may not want to give feedback to the company about their product directly. And it happens all the time. And if you don't actually like the value you're getting, you just go find another company. But what we can do is say, please give us regular feedback. We will share that with the company. And when the company gets that level of feedback, they're like, oh, I didn't even understand. We can totally fix that. Here's how we'll do it. And so it really helps ensure just a deeper engagement. And it's okay if the company ends up not being able to be the one to deliver the solution, but at least we're getting to those more transparent level of conversations.
Which is a huge value to your portfolio companies because they get a second chance or a better chance to get with Toyota.
Yes. Yes. And oftentimes it's something that works in one geography doesn't work in another geography. So we can actually really help facilitate those conversations.
Now, this portfolio success team is going to grow with the size of your portfolio, I assume.
Yes. Yes.
Okay.
So,
Very
yeah,
nice.
so keep your eye open. If this is something that you're interested in, we will certainly be hiring this over the next year or 2.
Very nice. So for anyone in the audience that is interested, reach out to Nicole. So let's talk also about your experience working for a VC with many LPs to now
Mhm,
work for a corporate VC with one LP.
mhm.
Um, what's the biggest change and what do you like the most and what were you surprised about?
There's pros and cons to each, and so I would say why I've ended up here is that example I used earlier about being able to walk down the hall and knock on somebody's door that's an expert. And so I say in venture capital, particularly people with a finance background like myself, I know just enough to be dangerous. So I know a little bit about a lot of things. I need to know enough to ask the right questions, but I don't have the time to be able to go deep in hydrogen and battery development and charging and robotics for factories. There's just too many things. I'd spend all my time learning. And so I love it that I actually have internal experts that are working on this on a daily basis. And I can kind of get access to how they're thinking about it through that. And it helps me validate a company faster. So if a company reaches out in that space, then I can just reach out to them and say, "What do you think?" And this is the fifth time I've seen somebody do this. It's not going to work. Or, wow, this is an actually new, interesting space. The way they're doing it, I would love to have a meeting. That's what I really love about corporate venture capital. The problem is, depending on the size of your company, some of those discussions take a long time. There's often cultural challenges that need to be overcome in a global company. And so it doesn't necessarily execute as well as you always hope, but it is a tool that you really have access to. On the
I,
financial side, oh, go ahead.
no, I was just going to comment. I talked to a number of people who were in corporate VC and moved to financial VC. And basically their conclusion is I lost my superpower. I had the
Yes. Yes.
mothership superpower, this expertise, and now I don't have them anymore.
Yes. Yeah, it's wonderful. I love being able to just be able to take it's like having kind of like a big consulting firm in your pocket because you can actually just say, "I need to learn about X or Y," and, you're able to just be able to take that in, and they probably have 15 decks that they've already built around it, and you can take them for lunch, and you can figure it all out. So it's a really wonderful superpower to have. I like how that's been described.
Actually, I think it's better than a consulting firm because they actually are the real experts doing the real work, not
Yes.
just advising.
Yes, but they've synthesized it all for you. So they've summarized it all into their deck, and so I don't need to know the details. I just need to know the key levers and then the outcomes that I can then help support.
I
So on the
cut you
financial
earlier, but I think you had a second point.
no, so that was yeah, that was the 2, is just having those experts in the field. The pro and con to both of it is that it's a great tool to access, but sometimes it is challenging with timelines. I often say as a CVC, we have to be these like time travelers where startups think in weeks and corporates think in years. And so I have a startup coming and they're like, I want to do a pilot. We're ready to deploy by January. And then Toyota's, that's great. That's probably going to be in our 2028 vehicle line. And so like how to actually be that time traveler to kind of bring those two groups into our portfolio success can help with that, like helping manage expectations between the two groups.
Oh, very nice. So another thing you've done is very early stage to now fairly late stage. What's the difference? What's the same?
So I would say, as I mentioned at the very beginning when I was doing the seed level due diligence, it's all about the future. It's sunshine and unicorns. Everybody's going to change the world, and everybody's so optimistic. And it's really like this shiny, rosy world. And we're going to really be able to do all of these wonderful things. And 15 to 20% of them will actually do it, and it's great. But in those types of startups, your best day and your worst day can be the same day. And so you really have to be responsive. You're often, as an investor, I was a very hands-on investor from the sense that I saw the founders I invested in as humans and part of their journey. And how could I just be a very founder-friendly, supportive investor once the terms have been negotiated and delivered? And so really just trying to help them think through what they were working on because they have to respond and analyze and iterate quickly and because the market's changing quickly and they often don't have product market fit. So it was a very different type of I would say, investor founder relationship than it is now. At growth stage, it's really more about you've analyzed the history, you've analyzed their financials, their management team, and you really have a lot of data to help inform your decision that can indicate future success. And then it's more about how do you actually manage much more of the detail around the board meetings are longer, very formal. There's all sorts of reporting, there's all sorts of complex projects and different business relationships to manage. Whereas in a startup board meeting, there's often not an agenda, a seed stage, there's often not an agenda, there's not a board package. And one's very forward looking and optimistic, and the other one is much more practical and really down into the weeds of complex relationships and deployments.
You have mentioned follow investments and staying with portfolio companies. Maybe you could share your philosophy about follow investments. When would you consider doing follow? When would you not?
So, follow on investments is an important tool for a fund because often seed funds either can't follow on or can't follow on meaningfully. And so, you really have to get that bang for your buck in your first check, not only for the economics, but to set the tone of the relationship. Because if the founder knows that you can't continue to support them financially, they're still going to want your input, et cetera. But in reality, they really need to focus on funding their company, and cash flow is important. And so they're going to have to take time away from their relationship with you to cultivate relationships with whoever's going to fund the next round. And so if you're able to fund their next round, it gives a little more time to build a stronger relationship and to be able to put clear milestones in place to say, this is how I'm going to make my next decision and how I'm going to be able to decide if I write a second check. And in the seed stage, that second check is really hard to make that decision because you're emotionally invested in this company and you know a lot more, and it's very difficult to tell a company that you're not going to fund them, and that might end up shutting down their company or having a material adverse effect on the company. And so that's really hard to do. So you really have to, from the onset, set that clear criteria as to how you're going to judge whether you make a follow on investment. And then you have to decide how much you're willing to deviate from that because it's like buying a house, right? You're going shopping. Here's my limit. And then you love the house so much and it's $100,000 more than you want to pay. Do you still pay it? So what's the criteria? So it's really important to bring in other team members to help with that decision at the seed stage.
There's so much golden nuggets in this response. I like how you describe it, which is setting the tone for the relationship, the
Mhm.
first check, the size of the check, but also being so clear on expectations about why you would or you wouldn't do a follow next. And you're right, especially for an early stage company, that follow investment is a very strong signal to other investors, especially for VCs who actually may be able to follow. If you're a VC that never does follow, there's no signal.
Mhm.
But
Mhm.
if you don't, well, you could, then the questions arise. How do you manage? Because this, I think, is one where we all struggle. How do you manage saying no to following an investment? And let's assume that you set the expectations clear and they haven't met your expectations.
So there's two things I would do when I was a seed investor. I did have the ability to follow on, but it was typically pro rata. So it was kind of in an in between stage where it was still important for me to build it enabled me to build a strong relationship with the founder, and I would be positive signaling, but I couldn't be the lead, for the most part. That's what I was doing. And so it's about setting expectations early, number 1, so that they know this is coming, so that if you do have to say no, it's not like it's a surprise, and it's not like they were counting
Mm.
on it. You've been very clear along the way. And when you have your board meetings or your check-ins or whatever relationship you've established, you are just putting that in on the agenda, cash flow. Remember, here's the milestones that we've agreed to. This is what my team, and sometimes you can blame your IC. This is what my IC is going to judge this potential follow-on investment against. So being able to do that is number 1. And the number 2 is an aside. What I would also do is build relationships with funds that I knew could follow on or knew that could make the investment. And so then I would meet with them regularly and I would give them updates on the kind of the portfolio companies I thought that they might want to keep in their pipeline. And so even to this day from 10 years ago, I'm meeting somebody like, "Oh, I owe you a beer because got me in. You shared that deal with me, and it's been great for my fund." And so I think being able to have that network of people that can follow on and being very transparent with them about how the company's doing enables you to bring that money to the table that you weren't able to bring directly.
Actually, maybe I don't think it's a question I've asked before in the
Mhm.
podcast, but when and how do you decide to share investment opportunity with your partners? And
With
I would like to look at both when you're going to invest and when it doesn't fit your investment thesis, but you're still introducing to someone else.
So you mean external, like other VC funds? Like when would I share a deal
VCs.
with you?
Yeah.
Yeah, yeah. And so I would say different people have a different structure. So I have a number of regular check-ins with funds that I know are aligned, and same with our fund of funds. Uh, if we have a company that's too early for us, we take a look at it and we'll send it to our fund of funds. We also have a sister fund called TDK Ventures that invests earlier than us, so we often flip a company down to them as well. And it depends. For the most part, you want to make sure you're sending good quality referrals. And that's really what I try to do most of the time. However, sometimes there's an interesting company that you're not entirely sure of, but you think they might like, or it's highly unusual, or they have a different business model that you've never seen before. And I always try to give some color. I always try to make sure I can say, here's the three things that I liked about it. And if you'd like to speak to them, let me know. Some people are very, I would say, structured and that they don't take a lot of calls outside of a very narrow thesis. And others are, I need to gain knowledge, so I'll talk to anybody. And I think one of the important things to manage with companies is not to waste people's time in the sense that I often get referrals and I would say, listen, it's not really a fit for us, but I'd like to take a call because I think we could probably have a great dialogue. So when you're done your fundraising process, reach out and we'll put 30 minutes on the calendar because I cannot participate in this round. And so managing those expectations with founders is important because their time is often very valuable, especially during a fundraising process.
Now let's talk about decision making. Decision making in venture capital is about deciding to invest or not to invest with information that's not always complete.
Mhm.
So, how do you handle uncertainty in your decision making?
And I think that is a really great question because even amongst our own teams and then amongst our investment committee members, it's just really important to understand the level of risk that everybody is comfortable with and the level of risk that us as a fund have agreed is acceptable or not acceptable. So often at the growth stage, the like when we do the analysis, it's very concrete. Everybody agrees that these are the financial metrics, these are the challenges with margin, or this is the potential exit multiple. The where we disagree is what the bar is. And so I think that's really an important element to make sure that you always clarify because you might say, "Oh, I'm fine with 1.5x, but maybe everybody else is thinking 3." Or maybe if it's a corporate, they're like, "We're really just doing this for strategic reasons, so we're happy with 1." And so making sure that is clear, I think is really important. And again, having checklists, we have really great checklists, and we also have really great legal counsel. And so having a lawyer that you trust can really help understand some of the mechanics of maybe a financing or how to get additional rights in a way that maybe you weren't able to negotiate, but they can give you additional insights to really help with that negotiation. And I think that's really important to be able to make sure that you can tell the story from both in a CVC from both the strategic and the financial angle.
I like how you smile every time you say checklist.
I do. I do. I have a spreadsheet for everything.
One of the issue we had last year was valuation. They were very high for the risk. How do you think about risk adjusted pricing in a way? And how do you see the valuations this year and maybe moving to next year? What's your expectation?
And this is an interesting question because we invest globally. And so significant differences between different geographies, but it's definitely getting less and less over time. And I would say that in maybe more developed and dynamic ecosystems like California, valuations are certainly higher, but you also have a lot more funds based there and a lot of sophistication. And they're actually kind of driving some of the prices down because they're not willing to pay for that. Or they're putting in I actually talked to an investor once and they said, "I'll give you your number, but my terms." And so you want to be a unicorn and have $1 billion valuation? Perfectly fine. I get 2 board seats, a 2x liquidation preference, like some all of these different things. So I think it one of the key elements for a fund to consider when making an investment is not just what the valuation is, but what the entire deal term kind of structure looks like. Because price is obviously one of the largest factors, but there's a number of other things that can really influence it. One thing I would say is climate tech. The valuations are, I would say, staying fairly stable from what we're seeing across the board in that. And how what's an interesting element playing out in that is a lot of climate tech is being driven by, I would say, regulation and incentives. And in regulation, particularly in Europe, we're seeing a lot of really solid climate tech companies with solid valuations or kind of middle of the road valuations, but longer time horizons because the industries that they're working in are being forced to adhere to regulation, which is very sticky, but it takes time. Regulation has to be phased in over time. And what's interesting from that point is it's something that's much more certain because if a regulation's in place, it's going to stay in place. And so it helps bring a little bit more certainty to the industry and to deploy money and valuations and all of the different factors around that. But then there's other areas where it's about incentives. And so there's a lot of incentives with like the IRA and other kind of regulations or other kind of policy elements, and that drives speed. And so a lot of companies, particularly in the US, are going in really quick to take advantage of incentives. And so that drives a lot of speed. But when that carrot is gone and all eaten up, will they still stick around? So that might inflate some early stage value or some earlier valuations or current valuations because there's this huge uptick in growth. But the question is, will that maintain over time if the incentive goes away?
I want to double click on Europe. And here I'm probably biased. TDK Ventures launched a multi-LP fund called Fund EX1 for energy transformation. And
Mhm.
this one is geo-focused to North America and Europe, where we believe there are a lot of tailwinds, which you cannot describe. How do you see Europe in clean tech 5 years from now, knowing how they start to be really sensitive to their energy dependency?
Yes. So, as background, I actually lived in Copenhagen for 2 years, and I say the average person in a coffee shop in Copenhagen is very savvy when it comes to climate tech and the sustainable development goals. I joke you can go into any cafe and 70% of the people in there will tell you what those 17 SDGs are and how it aligns with
Oh,
what
wow.
they're doing. And prices were high, like, it was just that the Nordics are a very different market than the UK, than the US, and I definitely am very positive about climate tech in Europe for 3 reasons. One is the big pension funds are demanding it. So they're demanding diversity, they're demanding ESG, and it trickles down into all the investments that flow under them. So the big institutional money is demanding that this happen. So it's coming, it's not going away. The second one is customer demand. And so the average customer, like all of the wonderful people in Copenhagen, they're demanding it. They're demanding that their energy be sourced from renewables. They're demanding that their car be electric. They're demanding that they have the infrastructure to charge those cars. And so the market has I would say, an opportunity there that the private sector is more willing to take up. And then lastly, like I said, regulation in particular. So all three of those things together are really driving a more stable demand. And so companies are more willing to go and deploy solutions. And then as an investor, when I know there's that stability there, it makes it, I would say, a more compelling investment case when I can have more confidence in their financial forecast and as an example, because I know that those are the key factors driving the market.
So you just mentioned pension fund, demanding diversity and ESG. I know you work in and you have worked in women in this. Can you
Mhm.
share a little bit the improvements in diversity or lack of in venture capital, but also the value of diversity of thoughts for venture capital?
So definitely believe in having diverse teams, and gender diversity is the most obvious, but it's also about ethnic diversity and diversity of education and experiences. I always use this example of my husband, who's an artist and designer, and I go home and I talk about all of these cool things that I'm working on, and he gives me this perspective, and I say, "Oh, thanks, but you don't understand my industry. Let's talk about something else now." And then 3 days later, after it's kind of settled, I'm like, you know what? That was a really great idea. I'm going to steal that idea and I'm going to talk about it now. And just having people that think differently, he doesn't have a spreadsheet for anything. I have inbox zero. He has 20,000 emails in his inbox. And so if you have those type of people on your team, you actually all think differently. It's very valuable. And I think as a manager of a fund, it's really important to encourage that diversity. So it's not just about having that diversity in your team, it's about encouraging that diversity to flourish, which sometimes means not necessarily conflict, but it's not necessarily always harmonious. And so how do you encourage people that have different like processes and workflows to be able to provide the value to the fund and to the investment opportunity that you're assessing to really ensure that you're getting the value of the brain trust that you put together. So it's not just enough to have diversity and to check the boxes, but to make sure that you're getting the right dynamic at the team to make sure that they feel comfortable speaking up. And some people, this happens a lot with women, and we've had discussions about this in all of the different teams that I've worked on in my career, is not everybody feels comfortable speaking up in a meeting. They may not have confidence. They may not have English language abilities if it happens to be in English. And so how do you provide numerous ways for them to be able to provide that, whether it's via email later, whether it's one-on-one, whether it's comments in a Google Doc? Maybe you have to call on them and say, "Oh, Nicola, like, last week you were telling me about this battery company and this interesting use case. Can you elaborate on that?" And then they have more confidence to speak because they know that you want them to say what you had previously spoken about. So it's really important, to have that. And just generally from a women in tech perspective, there are not enough women in tech, and Melinda Gates had a great article, that was put out yesterday about how she's going to actually invest in more fund of funds and use different assessment criteria, not because the funds won't do as well. It's just because there haven't been as many women to build the track records or to have the personal wealth that typically comes with the system and the checklist that you have to use now. And so, how do you change the checklist to be more inclusive, yet still provide the same amount of financial return? We're not doing the best job in having women in tech at the leadership level. It's coming, but I think we all have to do our part to just make sure that we're thinking differently when we hire and making sure that we have inclusive environments so everybody feels comfortable once we have our teams together. Make sure that we're being able to take advantage of these superpowers.
I like the word you use, brain trust. And diversity is all about making sure you have a diverse team. But for me, inclusion is actually about making sure each of these voices, these diverse voices, are heard. And therefore, I always feel like diversity without inclusion doesn't mean much. It's more of a checklist, just to say the word myself, but not as much. So I think you gave quite a few good tips about how to ensure inclusion, and it could be outside the meeting and in writing. Do you have any more tips for the audience? Because that could actually probably be the most important thing. Is diversity is one thing which I think hopefully is improving, and there's a pipeline, I think. But how do we move into leveraging the diversity in venture capital?
And one of the things that I think is tough in the current, I would say, genre of leadership is realizing that somebody that's 22 years old actually might have leadership abilities now. And just because they think differently or like to work from home all the time or have a different approach, don't write it off as Gen Z. Actually, spend some time like talking to them and asking for their input as a peer, as a human being that has maybe less experience than you, but they have a different experience than you. And I see so many amazing things that come from people that are just in their first analyst roles that are entering the workforce. They can actually add leadership value, not just kind of being a smaller part of a bigger team. So making sure that you engage the younger workforce that's coming in to make them feel included because they will speak up if you actually set that tone. So I think that's really important. And also creating an environment where people feel comfortable challenging you in a constructive way that's fact-based. Because oftentimes, if you're a 25-year-old female analyst, do you want to challenge a 50-year-old male managing partner? Maybe not. But if that managing partner sets the tone where you actually can tell me that you disagree with my investment recommendation or my financial analysis or whatever that would be, and you might purposely want to create those situations to set the team dialogue so everybody can actually start to participate and see how that goes. But it's up to the leadership to be able to make sure that you're creating that environment.
I love it. Now let's talk about hiring within that context, but it could go beyond that. Do you have any best practices in terms of hiring?
Yes. So number one, ask every single person on your team to share it with their networks because different people have different networks. So if you only share it to your university alumni or your maybe quite homogenous circle, you're never going to get new types of applicants. The second one is I actually got this idea from one of my startups that I invested in years ago. They said for every man, they interviewed a woman. And so the reason that they did that is women tend to we undersell ourselves on paper. And so when we came into the meeting, it actually maybe became more obvious that they were a better fit than might have looked on paper. And even if it didn't work out, the fact that you were able to give that woman some investment or some interview experience was very helpful. So that was another thing that was great. The other thing is to have blind kind of first assessments. So taking off school, taking off name and gender to make sure that there's no unconscious bias. And then lastly, making a short list and making sure at least 50% of the short list is diverse. So there's a greater chance you'll hire a diverse person.
And add one more because I think it links to this one man, one woman. All our job descriptions go through a tool called Gender Decoder to make sure that we don't have words that filters out good candidates because they don't resonate with them.
I've actually gotten feedback from a lot of women in the tech sector on that. I need a tech ninja. That was the biggest one for a while, saying you needed somebody that was agile on the software side. And a lot of women just, I would never apply to something that had that description.
Exactly. So let's talk about decision making in terms of investment, but this case is more from the investment committee. What best practices have you seen that the audience should be inspired about? Because you don't want too small, you don't want too big, you don't want slow for sure. So what best practice have you seen in terms of making the approval for the investment?
I have mainly been pitching to investment committees, but I have also been on investment committees for different funds, sometimes my own, sometimes for an earlier stage fund. And so there's a couple of things. Getting back to my accounting roots, sending the package out at least a week in advance, particularly if there's detailed memos that the investment committee has to read. Often the investment committee would have a range of members, some who may not have an expertise in that particular sector. So they may want to do their own research. And you need to give people a chance to ask questions and clarifications and things like that. So that's number one, I think, is having lots of time to read. The second one is working with your team to make sure that you distill the message very clearly. And so trying to understand what the key criteria your investment committee is using and how do you draw those linear lines. And so making sure that you reinforce that message. The other one I do is having it in person as much as possible to have these dynamic discussions around the investment and how you're going to support it. That's not always possible, but when you're getting into really complex discussions, especially if your investment committee might have people with different backgrounds and different language skills and different experiences, just it's easier to have in person. So it's a personal preference, not required. But I think that is something that just adds a lot of value. And it also takes away from, I would say, maybe the us versus them mentality, because a lot of people are like, I hope my IC approves this. And the point isn't to drive things through the IC, it's to have really constructive feedback because your IC is like a board, right? They're able to see that broader view and to help you see if you've missed anything as part of your assessment or you've misaligned with the criteria. So it shouldn't be an us versus them. So how do you have this really constructive dialogue? And we do something with our investment committee is after every meeting, we call it a Kaizen. So we actually then assess the dialogue and say, how can we improve our due diligence process or our documentation process for the next time? So every single meeting we assess, and then we're able to make sure we improve the next time.
Oh, wow. Okay. At least two golden nuggets. The collaborative aspect working with the
Mhm.
IC, which is not us versus them,
Mhm.
but then the constant improvement process, which is very Toyota. So I guess there is some DNA inside.
Yes.
For someone who's been pitching investment committee and who's been in investment committee, beyond this collaboration aspect, anything that you have improved over time and that you would expect people pitching to investment committee to use or to leverage?
So I think it kind of gets back to that is like, how do you create this type of environment in which you are really seeing the other person's point of view? So if I'm pitching to my investment committee, how do I try and see it from their perspective and make sure I've covered all the bases? And then when I put my investment committee hat on, how do I also see it the team's perspective? How can I give constructive feedback to the team? I really like this part of your analysis was great. I really felt that this was missing. And so how do you deliver that in a way that's constructive and helpful? The other element is really thinking about like how do you encourage the whole team to participate in some of these investment committee meetings? So in the sense that the analyst might not be pitching the deal per se, but how do you make sure that they feel included in the process, that maybe they are equipped to answer a question that comes up or something like that? How do you just make it a much more collaborative learning experience, not only for me pitching, but also me as the investment committee member? Because I found when I was on an IC, I actually learned lots of amazing things because tends to be outside of maybe my core element. I'm seeing such a variety that, and I've learned, I've taken tips from some of the memos I've seen other funds do and be able to incorporate them into my checklists or my memos going forward.
I really like it. Let's talk about woven capital and maybe thinking about the audience as the entrepreneurs now.
Mhm.
When should they approach you? How early should they approach you? What type of topics are you excited about this year, next year?
Great. Different people in my team feel differently, and I'm sure you have this on your team as well. Uh, because I'm this person that knows a little bit about a lot of things, so that I can go talk to all of my superpower kind of bench that I have within the
Yep.
Toyota business units. I actually like to talk to companies earlier, and I really want to know how they're approaching it. What are they thinking about? So I can get a better understanding. I find like all that knowledge comes into play when I'm meeting with the business units. I know what's on the ground because this is the one thing that CVCs have that not nobody else in our company has is we know what the market is doing in real time. Because startups are talking to customers, they're talking to people that have this real problem right now. And we were able to get that intel that I would say an engineer working on a project internally around electrification or hydrogen or factory, they don't have that network. And so I feel like that's an important thing to do to be able to get all of that knowledge and really know what's going on. With the out of as I said earlier, with the caveat to the company, this is our investment process. This is where you kind of are in it. And we can't participate in this round to make sure that expectations are managed. And so I think that's something I really like. Other people on my team and other funds I've worked at take a different approach, which is equally as valuable, where they want to stay much more focused on something that is really important as a priority area. And they tend to want to only talk to companies that are close to the investment period because they really want to make sure that they're doubling down and executing against a very clear milestone. And so I don't think either is wrong or right. It's just a different process. And for the most part, I am from a small town. I'm very social. I just love to know what's going on. And that's something that really gives me a lot of energy is when you talk to founders and you talk to companies just to see how they're thinking about things and how they want to change the world or how they're tackling a particular problem. I think it really gives me a lot of energy to see how they're doing that.
That's very nice. And what I'm excited about in terms of topics, sectors you're interested to invest, new
Uh,
business model.
so so how we work at our fund. And this is something that I know a few other groups do as well, is every quarter we pick priorities because as a global OEM, there are so many different topics that we could cover. And sure, we're still opportunistic as deals come to the door, but for the most part, we're really trying to focus each quarter. And the two areas that I put my hand up for this quarter were hydrogen and virtual power plants and vehicle to X or vehicle to grid. And number one, hydrogen is really important component of kind of zero emissions globally and really trying to understand what role our company can play in that and just what's going on and how it's being deployed and what the state of the market is. And then the second one is this virtual power plant and vehicle to X. And so if we have millions of these EVs driving around as little batteries, how do we make sure that we can use that to forego these large grid upgrades that need to happen? And so it's really just about optimizing this ecosystem. And so those are the two things that all of my podcasts and my books and all of my meetings for the most part are really focused on this quarter.
Should talk to my team because we looked
Nice.
into hydrogen, made an investment in hydrogen, and we're looking at VPP and V2X.
Yes. No, I have a few conversations on.
Now, I like this quarterly topics choice, which is very much about preparedness. You decide
Yes.
to really deep dive and then you meet. How much of that helps you once you have really researched the topic to know which company, which startup is king of the hill in a way?
Yes. So how we do it is what we do is the first thing is we do desktop research and we kind of put together we call it a market intelligence summary just for our own internal use. And basically, what is the size of the market? Who are the key players? What are the economics or the market dynamics we need to be aware of? And here's a list of companies in these different subsectors. And we reach out and we call all of them, or we call investors that we know are investing in that space. And it gives us a full picture. And then our portfolio success team, as part of their work, they're able to engage the business units that are doing those things. And it really helps kind of bring together what we're seeing in the market and what Toyota is actually doing and building and thinking about. And it kind of brings those two things together. And so then we're able to put together a plan that produces not only kind of the ability to take advantage of a market opportunity and financial returns, but also the ability to make sure that Toyota is really working on things that we can kind of put those two things together and get the strategic returns we need.
Very nice. Now, my last question is a double click, which is all of these insights. How do you make, how do you share that back to Toyota in a way that's actionable for them?
So we have a number of ways. It depends on the topic, depends on the business unit we're working with. So we can share those market intelligence reports. What we do is we the document, they comment, we present it to them, we have dialogue around it, and then we can actually continue to iterate on that document based on their very deep feedback. We have lunch and learns, and so we're able to bring in our portfolio companies, or we're able to kind of share those. One thing we do is, so for example, I'm the one dealing with hydrogen. I have a colleague looking at vehicle connectivity and connected cars. And so I don't really know what she's doing in detail, and she doesn't really know what I'm doing. When we finish those reports, what we do is we have a team meeting specifically for that. It's 2 hours long, and everybody has to read the material ahead of time. We then present it to the team, and then we have questions. So that way, everybody on the team can then learn about connected car or hydrogen. And so we've upskilled everybody in that space. So we're able to share that as a team first, and then as you're kind of going out and hunting. If I find a connected car startup, I know exactly the key sectors that she's looking for deal flow in, and then I can send it over to her as part of that.
Thank you, Nicole, for your time. There was a lot of golden nuggets. Really appreciate it.
Thank you. No, it was wonderful to talk.